Okay, so what if you could take 30 years of market-beating wisdom and boil it all down into just a few minutes? Well, that's exactly what we're going to do today. We are diving deep into Giverny Capital's annual letter to pull out the key principles that turned a pretty normal investment into an absolute fortune. Let's get into how they did it. First things first, just look at this chart. $100,000 put in way back in 1993 grew to more than $8.4 million by 2024. Now, you see a line going up like that, and you might think, wow, what a smooth ride. But believe me, it was anything but. This journey included 2 separate 50% market crashes and 7 other drops of more than 20%. So how on earth did they pull this off? Well, the answer wasn't luck, and it definitely wasn't about chasing the hot new thing. It was all about a set of timeless, durable principles that held up through every single market storm. See, in the end, it's the philosophy that really makes all the difference. And at the heart of that philosophy is one core idea. Investing is a marathon, not a sprint. This 30-year journey is just a masterclass in the absolute magic of long-term compounding. Let's break down the actual numbers. The portfolio delivered an annualized return of 15.1%. All that means is that, on average, it grew by that much every single year. Now, compare that to the general market index at 9.8%. That gap, that extra 5% a year, might not sound like a huge deal, but over 3 decades, that is what turns $100,000 into over $8 million. That, right there, is the power of compounding in action. So, what is the secret sauce here? It's really a huge shift in how you think. It's about stopping, thinking about buying stocks and starting to think about buying actual businesses. You're not a trader, you're an owner. And as a business owner, you really only care about one thing: intrinsic value. You have to forget about the daily up and down noise of the stock price. Intrinsic value is what the business itself is truly worth. It's the economic engine, based on its growing profits and the cash it pays out. It's the reality of the company. Now, check this out. This is the proof. Over almost 30 years, the actual, real-world growth of the company's intrinsic value was 12.9% per year. Okay, so what was the growth of their stock prices over that same time? 13.0%. They are virtually identical. And this right here, this illustrates maybe the single most important lesson of this entire philosophy. Over the long haul, the stock market isn't some crazy mystery. A stock's price will always eventually catch up to the real value of the business. You focus on the business, and the stock price will take care of itself. But look, if it's that simple, why isn't everyone doing this? What's the biggest thing that gets in the way? It's not the market, it's not the economy, it's the person staring back at you in the mirror. As the letter puts it so perfectly, most people in the market treat stocks like they're casino chips. They're just gambling on short-term price swings, and that creates a ton of noise and chaos. As a business owner, you have to learn to completely tune out that casino. And you want to know just how frantic that casino is? In 2023, the average holding period for one of the biggest S&P 500 funds was just 17 days. 17. People are jumping in and out of the entire US market in less than 3 weeks. It's madness. So what's the antidote to all that madness? Patience. Giverny's average holding period isn't 17 days, it's 8 years. That's the huge difference between being a short-term gambler and a long-term business owner. Of course, even with the best philosophy in the world, nobody's perfect. And honestly, one of the best parts of this whole letter is how brutally honest it is about mistakes. Because sometimes the lessons you learn from those are the most valuable ones of all. And here's a real twist. The biggest mistakes aren't always the stocks you bought that went down. Nope. They're often the amazing businesses you totally understood, you knew were great, but you never bought. They're the ones that got away. So what does a multi-million-dollar mistake of just not doing something actually look like in the real world? Well, it looks like a company called Cintas. So back in 2016, Cintas was this fantastic, steady, super profitable company. I mean, in baseball terms, it was a pitch right down the middle of the plate. But at $26 a share, it just seemed a bit expensive. So the decision was made to wait, for a better price. Well, that better price never showed up. Today, that stock is at $204, a 700% gain, completely missed just from waiting for the perfect moment. So after all these lessons, the huge wins, the painful mistakes, what can we actually take away from it all? Well, it all boils down to a really clear 4-level framework for managing risk. Okay, there are 4 levels. First step, diversification. Pretty simple. Own about 20 different businesses so you don't have all your eggs in one basket. Second, quality. Own durable, profitable companies that don't have a lot of debt. Third, valuation. Don't overpay. Always give yourself a margin of safety. And fourth, your own behavior. You have to think and act like a long-term owner, not a frantic trader. And here's the bottom line. You can analyze your way through those first 3 levels, you can read the reports, do the math, but that last one, controlling your own emotions, your own fear and greed, that is by far the hardest part of this whole game. Which really brings us to the final and most critical question this entire 30-year lesson leaves us with. When you're in the quest to reduce risk and reach your goals, who is truly your own worst enemy? More often than not, the answer is you.